Thank you for joining us for our webinar today, Practice Transitions from the Seller's Perspective. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Matt Vanderloo and Laura Zock. Matt and Laura are CPAs and principals with SVA Dental Services. They specialize in providing dentists the financial support they need as they transition their practices. For dentists selling a practice, Matt and Laura analyze the tax impact of a transaction, structure the transaction to minimize the tax impact, and guide the seller in maximizing their net cash flow from the transaction. And with that, I will pass it over to Laura.
Thanks, Jennifer. Welcome, everyone. And our topic today is going to be focused on the seller's point of view. Our agenda includes discussing transition strategies, how to go ahead and put a value on your dental practice, the tax considerations of a sale, what kind of due diligence you might be needing to do as a seller, and then also who should you have on your advising team as you consider preparing your practice for sale and then going through the process of transitioning your practice. So you've made the decision that it's time to think about selling your dental practice. You may want to transition out or sell now, but the big question really is whether your practice is ready for sale. Is your practice production increasing or is it decreasing? Are your financial statements and records clean and ready for interpretation, scrutiny, and the due diligence of a potential buyer and their advisors? And how about your lease? Is it a favorable one from the perspective of your potential buyers? Selling your practice is a lot like selling your home. You're going to want to take the time to spruce it up to get the maximum value upon sale. We recommend getting your practice ready for sale about 3 years before the ultimate time that you desire to transition. Why 3 years? 3 years is the typical minimum time period that potential buyers will look back upon to review production, financial, and profitability trends. Trends are an important part of establishing the value or price of your dental practice. Upward trends in production and profitability can command higher values in the marketplace. Meanwhile, declining trends can signal that your asset is declining in value. Our professionals at SVA Dental Services, such as Matt and myself, can work with you in this pre-sale period to help you identify areas to improve within your practice and provide solutions for you to implement to help achieve a higher value when when time to sell does come. Ultimately, we want you to get the best price for your practice that you have built up over the years. Oftentimes, the value of a practice upon sale is a key component to providing the retiring dentist with an income stream that they need during retirement. And when that time does come to sell, what might your options be? The two main ones are to sell your practice outright or to transition it to an associate. With the sale of a practice, you might consider selling to a dentist who has a dream to own their own practice, or perhaps as someone that is looking to relocate back to this area. Another option is to sell to a consolidator. Whether you like or dislike this, it is an option for sale, and often with very favorable to seller, cash up front kinds of terms. As with any other offer to purchase, the details need to be understood and evaluated. Or perhaps there's a group practice in your area looking to expand and might be interested in purchasing your practice. Another transition option to think about is to transition to an associate. Your transition plan may already be under your own roof in your associate. This could involve a transition in ownership all at once, or it might be over time if you're looking to wind down rather than to go from 60 to 0 miles per hour in under 5.2 seconds. Or it might mean looking ahead. Here's another area where that 3-year planning period comes into play, and adding an associate to your team with ownership transitioning at a future point in time might be the best win for you. Regardless of what option you decide to go with, here are the steps in selling your dental practice. First, as a seller, you're going to want to put a value on the practice. You're going to want to put that stake in the ground and say, here is the asking price or the range of price that I'm willing to consider. Next, you're going to need to market it, and this might be through the WDA or the ADA, or perhaps a broker, or by talking with professionals in the dental industry dental supply reps, consultants. Really what you don't want to do here is get the word out that your practice is for sale. Next is going to be negotiations. You're going to put your practice, you're going to put a price on the practice, but then you're going to have some offers that you're going to need to consider whether or not there's the one you want to take or not. And then ultimately, when it's all said and done, there's the closing and the actual transaction that transfers the ownership of the practice to the purchaser. Next, Matt is going to take us through the specifics of what is it that you're really selling.
Thanks, Laura. So Laura just went through all those great steps in the process of selling your dental practice. And step one is putting a price on the practice. And as we start to think through the process of putting a value on the practice and deciding how much you want to sell it for, one of the great ways to start is think about what are we really selling in this practice. And really, everything in the practice that we're selling, the practice itself, we can really divide into two high-level categories of assets. We have the tangible assets and the intangible assets. The tangible assets are all the assets that we can see in the practice or that we can touch in the practice, like supplies, the dental equipment, the furniture in the waiting room, the leasehold improvements in your space, things that other assets that we've already done, where we've already done work for patients and we're waiting to get paid, like the accounts receivable, could be the building. So we've got all these tangible assets that are things that we can see, touch, know what they are. They're a little bit easier in some cases to value. One of the things we always suggest for somebody is if you own your building and if you're including that in the sale, rather than have us as CPAs try and put a value on that building, we always like to have people get a value on the building established by a certified commercial real estate appraiser, somebody who really knows what they're talking about, really understands buildings, real estate, and can give you a good value there. There's lots of different ways we can determine the value on all of these tangible assets. For accounts receivable, we can simply run an accounts receivable aging report on the date of sale. Or we can actually look at collections after you sold the practice for work that was done before you sold the practice to see what you actually collected. For supplies, we can count the supplies on the shelf and put a value on all those. We can have somebody from a dental supply house come in and value those, or we can do an estimate based on your financial statements over the previous point of time. And for equipment, again, we can have that appraised by someone from a dental supply house, or we can make some estimations based on useful lives and methods in your depreciation reports. So those are all the tangible assets. The other big category of assets are those intangible assets. It's all the stuff in the practice that we can't see, we can't touch, but that we know is there. A lot of times you'll hear it referred to as goodwill or blue sky. Some people think of it as a covenant not to compete. The way we look at it is really it's the right, as you own that practice, to work with the patients that are in that practice and earn revenue off of those patients in the future. It can be difficult to value in that it's not something that's easy to see and determine a price on, and there can be a lot of variability from practice to practice about what this intangible asset, what this goodwill is, and how much it's worth. To give you a rough average, typically we see this run somewhere between 100% to 150% of 1 year's net income, and that's net income before the dentist compensation in the practice. And this is an area where we've seen a lot of volatility in recent past. In the last 5 years, we've really seen the goodwill value in practices trend up rather aggressively. So as we look to determine the price on the practice at a high level, there's two different ways we can do it. We know what all these intangible and tangible assets are, so we can figure out the value for each of those and add it all together to determine the price of the practice. Or we can look at the practice as one whole, ignore all the underlying assets, and come up with a price for that practice as a whole. So Laura, if we were to look at the practice as a whole, rather than as its collective parts, how would we look at putting a value on the practice?
Sure. When you're valuing the practice as a whole, as you mentioned, Matt, we're looking at the whole and not just adding up the value of the different components of the practice. A price can be set based on a percentage of the practice top-line collections. This is typically what we see in the industry. For example, $1 million grossing practice may sell these days for about 70 to 80% of collections, or maybe $700,000 to $800,000. If you've heard the term rule of thumb, this is the concept that we're talking about here. Alternately, a practice can also be priced by determining the total value of the various components of the practice. This is where Matt had talked about all those things you can put your hands on and the things you can't put your hands on in terms of the practice. What you do here is assign a value to each one of those components and then add them up for the total value of the practice. So you're going to take what you think the value of the accounts receivable is, add in the value of the supplies inventory, factor in a price for the equipment, and then come up with a component for the goodwill as well, and that together, those 4 items total is the purchase or the selling price of your practice. Either way, both the buyer and the seller must come to an agreement for a transition to happen, and there's various factors that are going to impact the price you negotiate on your practice. One of the main factors that impacts price is the physical location of the practice. Are you at the corner of Happy and Healthy? In other words, is it a Walgreens type location with easy access and great visibility? Location, along with favorable lease terms and an option to potentially buy the real estate, may command a higher price at the sale. And having a facility and equipment in good to great working condition is also going to command a higher price. Think about this from the buyer's perspective. When they come and look at your practice and consider themselves there, putting themselves in your shoes essentially, they're going to think that moving is expensive if they need to find a location. And an older, outdated facility or an equipment means that they might see a potential costly upgrade in the future. A few other factors that impact price are going to be doctor production and hygiene production ratios. Looking at these numbers are like an x-ray into the practice and how much potential there may or may not be in terms of productivity and efficiency for that new dentist and staff taking over. Current fee schedule is a consideration as well. A low fee schedule for the area might result in a potential for upside for that new owner who could bring the fees to market rates and perhaps collect more money when doing so, making that practice more valuable from the purchaser's perspective. Another key factor is, can the buyer perform all of the services currently performed, or could they do more? Think endo, implants, orthodontics, extractions. Will this new owner or dentist be able to increase or decrease the amount of work referred out to specialists? That too will impact the price from that perspective. The buyer will also need to consider who you are contracted with and your payer mix, particularly if you're selling to a group practice, as they will need to consider how does that fit in with their existing practice with those reimbursement rates. So now you and the buyer have hopefully agreed to a price, but it's not all about the price. Next come the tax considerations. Here's where it gets fun. Matt, what do we need to know about tax considerations on the seller's point of view?
From a seller's point of view, when we think about tax considerations, there are really 3 important tax considerations that we need to consider in the sale of a practice. And those are, number 1, the allocation of the sales price, number 2, the allocation of the sales price, and number 3, the allocation of the sales price. As we work with sellers and as sellers think about this, a lot of people really focus on what price am I going to get for my practice, and that seems to be one of the bigger considerations. What people don't always appreciate is that the tax allocation of the deal is going to impact how much of that sales price actually makes it to the seller once all of the taxes are paid on selling the practice. It's really the allocation of that sales price that determines how much cash you walk away from the deal with. To a lesser degree, the payment terms are also important. How much of the cash are we getting now versus how much are we getting over time? But really the big driver of how much cash you get out of the sale is how we get that sales price allocated. So as we talk through the tax allocation here, I just want everybody to picture in their mind a dental office that has $1 million of collections for the year, $600,000 of overhead expenses, so the dentist is making $400,000 out of the practice. And let's assume that the buyer and the seller have agreed on a $700,000 sales price. This is probably a fairly average kind of transaction. It's a pretty nice practice, grossing $1 million a year, and the $700,000 sales price is a relatively good price for that practice. So we're going to use these dollars to talk about the allocation of the sales price. The other thing to remember here is that just like with the sales price on the practice, the buyer and the seller have very different goals when we start allocating that sales price and we start allocating to the different assets that are being sold. You know, a buyer wants a lower sales price, a seller wants a higher sales price, so there's the two are working at odds there. And it's the same thing with the allocation of the sales price. The buyer is going to want a different allocation than the seller is going to want. Typically, the seller is going to want to pay as little in taxes as possible to get as much of that sales price into their pocket after the practice is sold. And the buyer is going to want to allocate that sales price in ways such that they get tax deductions as quickly as possible to help maximize their cash flow out of the practice, because they're going to need that cash flow to repay a loan to somebody that comes with buying the practice. So as we look at that $700,000 sales price, From a seller's perspective, we're going to try and allocate as little to accounts receivable, supplies, and equipment as possible, and as much to goodwill. So as we look at that practice as the seller, you might think, well, I've got a bunch of accounts receivable, but I think the buyer's only going to be able to collect $50,000 of that. So let's allocate $50,000 to accounts receivable. And I haven't bought much in supplies recently, so let's allocate $2,000 there. And all of the equipment I have, I've been using for the last 30 years in this practice, so we're going to allocate as little as we can to equipment. So maybe we allocate in total $100,000 to accounts receivable, supplies, and equipment, and the rest of the sales price, or $600,000, we're going to allocate to goodwill. The buyer's going to look at that a little bit differently. The buyer's going to look at your accounts receivable listing and say, I can collect every penny you have there, so let's allocate the full $65,000 to accounts receivable. The buyer's going to look at your shelves and say, wow, seems like there's a lot of stuff, a lot of supplies on the shelves here. It would cost me a lot to buy this much from Shine or someone else, so I think it's $25,000 worth of supplies. You might have been using this equipment for a long time, but it's all really great equipment that still works well. And if I had to buy all of this new, it would be incredibly expensive, so I think the equipment's worth $310,000. So let's only allocate $200,000 to goodwill. And then in addition, I want to pay you $100,000 to come in here kind of as a consultant and help me learn how to run this practice as a business person and really understand the practice. So we're both allocating the $700,000, but we're allocating it into very different buckets. And there's a big reason for that. As we look at how this is going to get allocated from a seller's perspective and get taxed from a seller's perspective, the accounts receivable, the supplies, the equipment, and the consulting agreement are all going to be ordinary income to the seller when we report this transaction, the sale of the practice, on their tax return. And ordinary income is going to get taxed at the highest potential income tax rates. However, the goodwill in the practice, the seller can probably get taxed as a long-term capital gain, and therefore is going to get lower tax rates on that income. From a buyer's perspective, they want everything in accounts receivable, supplies, and the consulting agreement where they're going to get an immediate tax deduction for those. So they're going to immediately free up cash flow in the practice. And if they can't get that, they're going to look for an equipment allocation where they're going to get to write it off over 3, 5, or 7 years, depending on exactly what it is. And the last place the buyer is going to want to allocate dollars is to the goodwill. Because for goodwill, the buyer has to deduct that over 15 years. So it's going to take them 15 years to get all the tax deductions with those dollars, which is really, most loans to purchase a practice aren't going to get repaid over 15 years. They're going to get repaid over 5, 7, maybe 10 years. So if we have to pay back the bank in 7 years, but we don't get all the deductions for 15 years, it can really create a cash crunch for the buyer. So Laura, what does this really mean in real dollars? How much tax are we really talking about with this kind of an allocation?
We're talking about some good tax savings here, just from the seller's point of view, if they can negotiate this more to the numbers that you talked about, Matt, in terms of allocations of price between goodwill. Really, in the example you gave, Matt, the seller's allocation of goodwill was $600,000. Again, taxed at long-term capital gains rates typically. The buyer wants to allocate $200,000 of goodwill, or of the price towards goodwill. So we're looking at a $400,000 difference in this example here. The tax rate differential between that is 17%, which is potential tax savings to the seller of $68,000 here. So a pretty substantial savings on that purchase price, right around 10%. The difference in the tax rates here we're looking at is the difference between the long-term capital gains rates and the ordinary income tax rates, which is currently about 17%. So this is why it's a really big deal, particularly from the seller's point of view, when you're looking at trying to maximize your cash flow from transitioning of the practice. Once the tax allocations are negotiated by the buyer and seller, the IRS has something that we need to file with them so that they know what's happening both on the buyer side and the seller side. And this is Form 8594. The tax allocations should be written in an agreement that's signed by both parties. And then both the buyer and the seller must complete this IRS Form 8594 and attach it to the tax returns in the year of the sale. Typically what we see as part of the transaction process is that one of the parties is preparing the Form 8594, knowing that they're putting the right numbers in the right boxes, and then providing that to both the buyer and the seller to send in with their tax returns when that time comes in March or April. And yet one more consideration to talk about briefly related to dentist practice goodwill. And that question is whether it's a corporate asset or an individual asset. You might be wondering, why does this even matter? Well, it's a hot tax issue with the seller and the IRS, because if goodwill is considered an individual asset, that means capital gains treatment for the seller, which means less taxes paid. If it's considered a corporate asset, that means ordinary income tax treatment for the seller, meaning more taxes paid on the transition of that practice. Our takeaway point here, because we're not going to do a deep dive into this because it's a more complex topic than we have time to talk about today, is talk with your legal counsel and your CPA as you're getting your practice ready for sale to discuss the various considerations and the specifics of your practice and what steps you might be able to take so that there's documentation that the dental practice goodwill is considered a corporate or an individual asset rather than a corporate practice asset. Now let's talk about money changing hands, because that's typically something that people have questions about as they're working through a transition. Matt, what do you have to say here? What recommendations?
Well, I think most sellers like the recommendation that they should bring a suitcase with them to the closing so that they can just collect all the cash right there at closing, put it in the suitcase, and take it all home.
And an armored vehicle?
And an armored vehicle and some guards to make sure it doesn't disappear on the way home. But, and I think the reality more recently is that that's, well, not cash exactly, but getting paid in full for the practice is not a completely unreasonable expectation if you're selling your practice. As more and more dental consolidators have gotten involved in the marketplace, it's become more and more common for people to get that full purchase price at closing. And in the last 3 to 4 years, lots of banks have gotten more and more comfortable with lending the full amount of the purchase price to even a relatively new dentist who's looking to buy a practice. So it can be very common to be able to get the full asking price of the practice in cash at closing. If that doesn't always happen, a lot of times we'll see the accounts receivable piece of the purchase price get paid out over the first 12 months after the sale. So really, as those old accounts receivable are collected by the new owner, they just turn those right over to the seller. That's one common way to handle accounts receivable. And we do still see some transactions that are financed by the seller. So instead of having the bank finance the deal or getting all the cash at closing, the seller may take back a note and get paid off on that note over 5 or 7 years. A lot of times, some of the motivation here is that having the seller finance the deal can also help the seller manage when they have to report the taxable income. So if the seller finances the deal, they don't have to report all the income right up front on the date of the sale, but they will report the income as they receive the principal payments back from the buyer. So that can be partially a tax strategy there. We'll also see in those situations commonly a land contract on the building if the building is owned by the owner or by the seller. And then we've seen lots more practices being sold to consolidators in this marketplace and in Wisconsin in general. Typically that's a lot of cash at closing. The consolidators have the financial backing to be able to buy the practices outright. We do encourage people to look really closely at the details of those deals, especially at any employment agreements that continue on after the practice is sold. We want to look at everything in total and see what everything says and make sure it looks like a good deal all the way around and all the way through the life of the deal. A few times we've seen really nice purchase agreements with really nice terms on the purchase, but not as nice terms on the employment agreement after the fact. And if we look at the two together, suddenly that purchase price doesn't look nearly as good as it did initially. So once we've come to kind of a broad agreement with a high-level agreement with the buyer about price, tax allocation, then it's time to get into the weeds a little bit more and do a little bit more due diligence. Usually the due diligence is skewed a lot more towards the buyer. The buyer's going to want to spend a lot more time getting comfortable with the practice, the employees in the practice, everything that's going on there. So that's usually it's a lot more time invested by the buyer, but there are some important things to consider as the seller. The first one is the buyer's financial standing. Can the buyer go to the bank and get a loan for the entire practice purchase? If they can't, or if you don't want them to because you want to try and manage that cash flow and manage the taxable income, are you comfortable with the buyer's financial position? Are you comfortable that they're going to be able to run the practice and that you're going to get all those payments out of the practice? So that's one of the important things that a seller is going to have to consider. I'd really like to prep the seller for the amount of information that they're going to have to provide to the buyer in this process. The buyer's going to want to see a lot of stuff about the practice, and it's going to feel like a steady stream of paper and information going out of your office to the buyer. The buyer's going to want to see insurance contracts, lease agreements, employment contracts or agreements with any employees, patient information. They're probably going to want to review charts of some patients. They're going to want to look at the employee files. They might want to talk to the employees. There's going to be a lot of time invested on getting all the information that the buyer needs to get comfortable with things. Part of the due diligence process should also be agreeing with the buyer about the patient communication. How are we going to communicate to patients that the practice has been sold? When is that going to happen? What exactly are we going to say in that communication? How are we going to communicate it? Is it going to be email, text message, letter, or phone calls? As the seller, you've probably been invested in this practice for a long time. You probably have great relationships built up with your clients, your patients, and you're going to want to have some part of the decision process there and have a lot of time invested in communicating or deciding how this all gets communicated to your patients. You're also going to want to think about, as a part of this process, how we're going to introduce that new dentist. Are they going to come in and work in the practice for a week, a month, a day, or not at all to be introduced to the patients? Is it going to be that you close the door, lock up the practice on Friday, and never set a foot back into practice, and the new dentist comes in on Monday morning, opens it up, and takes over? Anything can work. It's just making sure we all understand what we're going to try and accomplish and how we're going to try and accomplish it up front before we finalize things. And then the last part of that due diligence process is looking at if there are any of those post-ownership agreements. Is there a covenant not to compete? Is there some sort of consulting agreement where the new owner wants you to come in and help with the management of the practice or show them how to manage the practice? Or is there an employment agreement? Is that new owner going to want you to come back and cover while they're on vacation, or if they can't work through the practice as quickly as you can and need some help covering their patient load? So we're going to want to make sure those get negotiated, agreed to as part of that due diligence process before anything gets signed. And one of the keys to being able to successfully navigate that due diligence process is making sure you've got a team in place to help with that. And I think at a minimum, there's two really important people you need on that team. You need your attorney involved, and you need your accountant or your CPA involved. You're definitely going to need your attorney there to, at a minimum, review all the documents that are going to be a part of this process. And depending on how it's going, you might want your attorney to be the one driving the process and doing the initial draft of all those documents, making sure, at least for the initial draft of everything, that it's drafted the way you wanted it and in your favor. And then, as we've talked about today, I think it's really important to have your accountant CPA involved to help you determine the price on the practice. You're going to want somebody who's familiar with dental practices, familiar with the transactions that go on, the sales and purchases that have gone on with dental practice to help you get the right price on that practice. And you're also, as we've talked about, really going to want them there for the tax allocation part. And it's really important how much of that purchase price is going to end up in your pocket at the end of the deal. And you need both your attorney and your accountant, CPA there working together to help you get the best possible outcome. So with that, we promised that there'd be time for questions here at the end. Remember, you can submit those online if you've got any burning questions here.
Yes, the chat feature again is on the bottom of the PowerPoint as you hover over it. Feel free to type in your questions there and we will answer them as they come in. And I do believe that, Matt, you had a question that came through?
Yeah, so we had one come through. We've talked a lot today about people who own the practice and the building. Somebody's wondering, do we always want to sell the building with the practice, or do we have to sell the building with the practice, or can that be two separate transactions, or what are our options there? And I think you've got plenty of options. The sky's the limit there. I think what we see most often is that most buyers, when they buy the practice, if the seller owns the building, also want to own the building if they can. So if they can, from a financing standpoint, make it all work, they'd like to buy both at the same time. But that doesn't always have to be the case, isn't always the case. So it is possible to sell just the practice and still own the building. There's going to be a little bit more in the due diligence process, if that's the case, to negotiate the new lease between you, the old practice owner, continuing on as the building owner, and the new practice owner to make sure it's a market rate lease and they've got all the fund protections in there that they want and you've got all the fund protections you want. So it certainly can work to not sell the building at the same time. It's just going to add a little bit more in the due diligence process. And if you can get that deal to work, it can be a nice source of income in retirement too, to get that monthly rent check. And
I'll add to that, perhaps there's situations where the purchaser wants to acquire the building but perhaps can't make it work right away. And there you might end up with a right of first refusal, so that if you are looking to sell your building at some point, that person who bought your dental practice will have the first opportunity to consider buying that building before you offer it out on the marketplace.
Great. Looks like we are out of time. If you do have any further questions, Matt and Laura's contact information is on the screen. Feel free to call or email them with any questions, and they will be happy to help. So thank you, Matt. Thank you, Laura, for your time, and thank you, everybody, for joining us today. Have a good day.